Hello, savvy investors and financial enthusiasts. Welcome back to our channel World of Wealth, where we're about to dive into the world of smart money moves. If you're looking to make your money work for you in 2023, you're in for a treat. Investors may still be in shock following a period of high inflation and the Federal Reserve's swift increase in interest rates. Some investors might believe there is nowhere good to invest because many prominent experts worry that a recession could be just around the horizon. However, if you broaden your time horizon for investing, the remaining months of 2023 may position you for future gains. The list below offers you a balanced combination of growth and safety in what appears to be a challenging market situation by starting with some safer options and moving on to those that should produce better returns, but may be more volatile. Firstly, why should you invest in the first place? Well, you can use investing to supplement your income, finance your retirement, or even get yourself out of a tight spot financially. Above all, investment increases your money, enabling you to reach your financial objectives and gradually boosting your purchasing power. Or perhaps you recently sold your house or received a windfall. Choosing to put your money to work for you is a good choice. There are numerous methods to invest, ranging from low-risk options like corporate bonds and money market accounts to higher-risk options like stock index funds. Safe options include certificates of deposit and money market accounts. That's fantastic news since it means you can select investments that meet your risk tolerance and give a range of rewards. Additionally, it implies that you can mix investments to build a balanced, diversified, and hence safer portfolio. Now let's see what we can invest in 2023. Number 1. High Yield Savings Account. For people who may soon require access to money, a savings account is a suitable option. For risk-averse investors who wish to eliminate the possibility that they won't get their money back, a high-yield savings account is a good option. As long as you keep under federal insurance limitations, you won't have to worry about losing your money because many of the banks that provide these accounts are FDIC insured. Although high-yield savings accounts are regarded as safe investments, similar to CDs, if rates are too low, you face the danger of losing purchasing power over time due to inflation. Number 2. Short-term certificate of deposit. Retirement investors who are able to lock their money away for a while and don't require immediate income may find CDs to be a viable option because of their safety and greater returns. Risk-averse individuals who need money quickly and are willing to tie up their cash in exchange for a little bit higher income than they would get from a savings account can consider a certificate of deposit, CD. CDs are regarded as risk-free investments. They do, however, come with reinvestment risk, which is the danger that, as we saw in 2020 and 2021, investors may lose money if they reinvest their principal and interest in new CDs with lower interest rates as interest rates fall. It's important to note that inflation and taxes could significantly erode the purchasing power of your investment. Number 3. Series 1 Bond. Series 1 bonds, like other government-issued securities, are appealing to risk-averse investors who don't want to take any default risk. For investors who wish to safeguard their investment against inflation, these bonds are an excellent choice. Investors may use up to an additional $5,000 of their yearly tax refund to buy Series 1 bonds, but they may only purchase a total of $10,000 in a single calendar year. The Series 1 bond shields your money against inflation, a major drawback of buying most bonds. These bonds are regarded as among the safest in the world against default risk, much like other government-issued securities. Number 4. Short-term corporate bond funds. For investors seeking cash flow, such as retirees, or who wish to lower their total portfolio risk while still earning a return, corporate bond funds can be a great option. For risk-averse investors looking for a little bit more income than government bond funds, short-term corporate bond funds can be beneficial. Short-term corporate bond funds are not FDIC insured, much as other bond funds. There is always a potential that businesses will have a fall in their credit rating or experience financial difficulties and make bond default. Make sure your fund is comprised of top-notch corporate bonds to lower that risk. Number 5. Dividend stock funds. Individual stock purchases, dividend paying or not, are better suited for experienced and intermediate investors. However, you can lower your risk by purchasing a number of them in a stock fund. For practically any type of stock investor, dividend stock funds are a fine option, but those seeking income may prefer them. These can be appealing to investors who require income and have longer investment horizons. Dividend stocks carry risk, just like any equity investments. Although they are regarded as being safer than growth stocks or other non-dividend stocks, you should take care when selecting them for your portfolio. However, you eliminate many of these risks by buying a dividend stock fund with a diversified collection of assets, reducing your reliance on any single company. Number 6. Value stock funds. When stock prices rise, as they occasionally do, many investors question where they should put their money. Value stock funds may be a good option. Value stock funds are a fantastic choice for individuals who don't mind the volatility that comes with stock investment. To weather any market hiccups, stock fund investors must have a longer-term investment horizon of at least 3 to 5 years. Due to their low cost, value stock funds will typically be safer than other stock fund types. However, because they are still made up of stocks, they will vary far more than safer assets like short-term bonds. Government insurance does not exist for value stock funds either. Number 7. REIT index funds. For income-focused investors like retirees, REIT index funds offer sizable dividend payouts, which entices them. However, REITs also frequently increase in value over time, so capital growth is still a possibility. Investors must have a long-term perspective and be prepared to deal with volatility because the prices of publicly traded REITs can change significantly. Because a REIT index fund allows for diversification and allows you to purchase multiple REITs within it, it can significantly reduce the risk associated with owning individual REITs. However, the price of the fund will change, particularly when interest rates rise. But beware of REIT funds that aren't listed openly. Number 8. S&P 500 Index Funds. An S&P 500 index fund is a fantastic solution if you wish to attain larger returns than more conventional banking products or bonds, albeit it does have more volatility. For novice investors, an S&P 500 index fund is a great option since it offers extensive, diversified exposure to the stock market. Any stock investor searching for a diversified investment who can commit to holding their investment for at least 3 to 5 years should consider an S&P 500 index fund. Due to its composition of the best firms on the market and extensive diversification, an S&P 500 fund is one of the less dangerous ways to invest in equity. It still involves equities, therefore it will inevitably be more erratic than bonds. Number 9. Nasdaq 100 Index Funds. An excellent option for stock investors seeking growth who are prepared to put up with high volatility is a Nasdaq 100 Index Fund. Investors must be prepared to make a long-term commitment of at least 3 to 5 years. When investing in an index fund, dollar cost averaging might help you manage your risk better than paying all at once. This group of stocks has the potential to decline, just like any publicly traded company. While some of the most powerful tech businesses are represented on the Nasdaq 100, they are also frequently some of the most expensively priced. Because of their high valuation, they are probably susceptible to a swift decline in an economic downturn, yet they might have a swift ascent in an upturn. Number 10. Rental housing. For long-term investors who wish to manage their own properties and provide consistent cash flow, rental housing is a viable investment. You won't have the convenience of using your internet-enabled smartphone to buy and sell your assets in the stock market with a simple click or tap. Even worse, you can occasionally get a call about a pipe that has burst at 3 in the morning. Remember, investing is a journey, not a get-rich-quick scheme. Stay informed, review your investments regularly, and adapt your strategy as needed. Each of these options presents unique opportunities and potential for growth. Which investment avenue has piqued your interest? Let us know in the comments below. Remember, investing involves risks, and it's essential to conduct thorough research and consider seeking advice from financial experts before making any decisions. Don't forget to hit that like button, subscribe for more enlightening content, and embark on your journey towards financial prosperity. Until next time, stay informed, stay wise, and happy investing.